So, all right. So, the topic for today is acquisition achieved in stages, which is known as piecemeal acquisition. Achieved in stages, piecemeal acquisition. So, first of all, what is a piecemeal acquisition? Let's start from there. So, piecemeal acquisition is acquisition achieved in stages, right? That is piecemeal. It is called piecemeal acquisition. Acquisition achieved in stages. This is a whereby you want to acquire a company, but you do not have the resources to acquire the company at once. You now decide to acquire the company in piecemeal. Okay, that is what piecemeal is all about. So you do not have the resources to acquire the company at once. However, you now acquire the company in bits. So that is what piecemeal is all about. So that is acquisition done in stages. Okay, so e.g., for example, now H acquired H in S1. Let's say first acquisition. H in S1, initially H acquired 10%. Then later on, we have another one again, second acquisition. H in S1 again, he acquired, let's say, another 20%. Then later, after a hammers jack point, we have H in X1 again. Let's say he now acquired 30. Okay. So you can say in this case now, H want to acquire X1. However, the acquisition is not done once, it's done in piecemeal. So you can say initially H acquired 10% in X1. It could be on different day. Let's say this one was done 31st December 2018. Then the second one took place on 30th of June 2019. And the final one took place on 31st December 2019. So this is an example of a piecemeal acquisition. So if you look at this now, the total acquisition, total is what? That's 60%, correct? That's the initial one was 10, followed by 20, followed by 30. Everything is 60, right? Then your NCI is what? Is 40. So this is how piecemeal acquisition is all about. However, there is a principle I want to start. So the question is, at what point are we going to start consolidation? Can we consolidate when we acquire the first acquisition? Or is it going to be when we acquire second? You know, after you have acquired second, the total is now what? 30. Then when you now acquire the third, then it now changed to what? 60. So the question is, at what point are you going to start consolidating? So can anyone answer these questions for me? At what point do you think we're going to commence the consolidation? Is it at the point of acquiring the first acquisition or the second or the third? So who want to answer, please?
I think is the
I
third
think at
one,
the third.
because the first one, it doesn't have control yet. Even the second one, it doesn't have control yet. So it's when you acquire the third one that it has control, the summation of
Okay,
everything.
perfect. You are 100%. So consolidation under piecemeal acquisition, consolidation will commence the moment consolidation will commence the moment control is achieved. Okay, you start consolidating when control is achieved. So when you acquire the first acquisition, it is just an ordinary investment. So you treat it as a financial instrument. Then when you acquire the second one too, that is it making it now 30. You know, initially it was 10 plus the second one, that is 30, right? So you don't when it is 30, you treat it as an associate. So at this stage now, it will be accounted for as an investment in associate. So at the point of acquiring the second, then it is when you now acquire the third, that is when you can now consolidate. It is at the point of this third acquisition that we can claim that we have a full control over the subsidiary. So consolidation will start the moment the control is achieved. So that is what you should take note under piecemeal acquisition. Now, before we solve our case study, let me quickly run you through a principle to under piecemeal acquisition. So how do you calculate goodwill computation now? Goodwill. So let me give you a goodwill computation. How do you calculate goodwill under goodwill? Let's say H acquired 40% of X1, okay, on 31st December 2020. Then H further acquire additional 20% in X1 on 31st December 2021. Okay, let's assume this is exactly what happened. So in this case now, you will notice that H in X1 initially was 40. Just a minute, let me attend to a call, just a few seconds, right? Just a few seconds. All right, okay, so H in X1, it was 40%. Can you guys hear me? I've unmuted, right? Okay, great. H in X1, 40. This one was on 31st December 2020. Then we have H in S2. I hope you guys can hear me, right? Because technology can messed up. I've omitted here.
Yes,
but
sir.
thank you.
Sir.
Thank you. Only the ladies are speaking this morning. Please continue. Your voice is so cool and calm. This one alone is cooling down the temperature. The guys should not speak because their own voice is always calm. I don't have them this morning. All right. So see what we have now. So this is exactly what we have. So in this case now, let us calculate the.
Hello, sir.
Mudaro, who asked you to speak?
Hello, sir.
Hello, I'm with you.
H in S1, not S2, sir.
Did I wrote H2?
Yes, sir.
Well, you guys don't scatter my head though. Okay, it's okay. S1, back to class now. Thank you, Mr. Nathaniel, for calling my attention to that. Okay, all right, so this is exactly what we have. So we want to calculate the goodwill now for this kind of scenarios now. We want to calculate the goodwill. So now how do you calculate goodwill? So the first thing you do is the purchase. You say you pick the purchase consideration. Oh, let me reduce the font size. It's too big. Change it to 14. Yeah. So the first thing you do is the purchase consideration of new acquisition. You pick it. So meaning that the 20% that the new one is 20%. The 20% that you just acquired, you pick the purchase consideration, right? This 20%, you pick it. Then for the one that you have acquired before, you will not use the purchase consideration again, no. This 40%. However, they will give you the fair value. So you pick the fair value of the initial acquisition. So that is exactly what you need. The initial one was 40. So they will give you the fair value of that. So the difference between this fair value that you are giving for the initial acquisition and the cost, this 40%, you will have acquired it for a particular amount. Let's say you bought it for $10,000, right? And the fair value of the initial acquisition now is $12,000. So you recognize that $12,000 here. So the difference of $2,000 will be recognized in your group reserve. Okay, the difference will be recognized in your group reserve. That is the difference between the fair value of this initial acquisition and the cost will be recognized in your group reserve. So let me note it down. So the difference between the fair value of the initial acquisition and the cost of the initial acquisition will be recognized in group reserve. All right, so that's it. That's for that. So the difference will be recognized in the group reserve. So now we've taken the purchase consideration of the new investment, which is this 20%, and we have also considered the fair value of the initial one, which was 40%. Now, so by the time this is now your total purchase consideration. So this is that is 20 plus 40, that is for the 60%. This is your total purchase consideration. Then if you are using proportionate share of net asset method, you continue with the asset acquired and you split it the way we used to split. And also, if you are using fair value method, so you need to introduce fair value of non-controlling interest. That is the fair value of NCI. You need to bring it in here. Okay. So you bring in the fair value of your NCI. So once that one is done, once it is done, you have this, then you can now consider the asset acquired, right? Those assets that you have acquired. So you're starting from your ordinary share, okay? You pick the ordinary share, then your pre-acquisition reserve, you pick your pre-acquisition reserve. Then if there is any other one, like all those fair value adjustments, any other asset at acquisition, you pick. So you total. Okay, you total it, bring it here. So the difference is your goodwill. If it is positive, and if it is negative, it is called gain on bargain purchase. So, ladies and gentlemen, do you understand how to calculate goodwill under piecemeal acquisition? Please, I need your feedback. Is this clear to everybody? Before I proceed?
Yeah, yes, sir. Yes, sir.
See, it is very clear, Abby. Guys, yeah, you can speak. Oh, don't say because I say ladies' voice and you guys now refuse to speak. Guys, yeah, tell me, is it clear, guys? Let me talk to my guys now. Is it clear, please? SRO now.
Yes, sir.
Hello,
I
sir.
thought. Yes, I
Hello,
can hear
sir.
you. Yes,
The
I
fair
can hear
value
you.
that we are using there for the one that we acquire first, is it the fair value that we are going to be given in the question or the cost of that acquisition?
They will give you the fair value in the question. They will
They
give you
must
the
give
fair
us the fair
value.
value.
They will give you, or if they did not give you, they will tell you how to calculate it. Like the case questions we are going to solve now, you will see. And also, the difference between that fair value and the cost will be recognized in your reserve. I think that is what I wrote here. Okay. All right. So I am done with my explanation now. So let's take our case study. So bring out your question pack. Your question pack. Go to case study number what, sir? Go to case study 4. Case study 4. That's on piecemeal. This is a question. So I want someone to kindly help us in reading out the question. Please, this is the question, case study 4. Someone should please read for us and we will solve the question immediately.
Okay, Oscar acquired 25% of Tiga on 1st of January 20X for $2,020,000 and exercised significant influence on financial and operating policy decisions. Tiga. The value of transferable assets and liabilities equivalent to the book value, and Tiga's reserve stood at $5,800,000. Further 35% stake. Okay, a further 35% stake in Tiga was acquired on 30th September 20X2, $4,200,000, paying a premium over Tiga's market statute control. The fair value of Tiga's transferability that date was $9,200,000, and Tiga's reserves stood at $7,800,000. As 30th September 20X, Tiga's share 10.5. So we have the summarized statement of financial costs. And the difference between the fair value the identifiable assets and liabilities of TIGA and their book value related to TIGA's grants. Grants were estimated on average remaining useful 30 September 2022. Income and expenses are assumed to accrue evenly the year. Neither company paid dividends during the year. Oscar elected to measure NCI state of acquisition at first. No impairment losses recognized necessary required to prepare the consolidated statement of financial position on December 20x2. The consolidated statement of another comprehensive income group dated 1 December 20x2.
All right, thank you so much. So this is the question we are solving. So if you look at the questions now, Oscar acquired 25% of Tiger on 1st of January 2000 for 2 million. So this is the first acquisition, right? Then later in the second paragraph, they now said a further 35% was acquired. So meaning initially we acquired 25, then later we now acquired 35. That's making it about 60, right? 25 plus 35, that's 60. Okay, so that is what we have now. But note that there is something that we need to do first. Initially, when we acquired the 25%, that the investment was treated as an investment in associate, right? Because the company, they said it has over significant influence. That means it was an associate. Then when we now acquire the further 35%, so the status of the investment now change from being an associate to subsidiary. So the moment the status of the investment change from associate to subsidiary, you need to derecognize the associate. And in that derecognition process, there is going to be either profit or loss on derecognition because you are derecognizing associate to now become a what? A subsidiary. So as you are ending the relationship with the associate, you are now starting a new relationship known as what? Subsidiary. Because 25% has changed to what? To 60. Right? And the changes took place when we acquired the 35%. And if you check, this 35% was acquired on 30th of September. So 30th of September is the date that the Tiger stopped being a what? An associate. It is on that date also that the Tiger now become what? Subsidiary. So you can just assume that when we own 25%, Tiger was like a side chick. But the moment we now acquire 35% on 30th of September, then now become a full housewife or a full wife from being a side chick to wife. So that's exactly what happened. So this relationship changed from being an associate to a subsidiary on 30th of September. So we have to take note of that. It is very, very important because there are some adjustments that we're going to pass to recognize the associate. So in most piecemeal question, you need to always be wary of this kind of issues, moving from one investment to the other. So there will always be some stuffs like all this, the recognition palaver. So you need to take note of it. It's very, very common under piecemeal acquisition. So without much ado, let us start. So I assume that you have done your skeleton. That's for the, let's do it together now, right? Why not? Oh yeah, let's do it together. But you'll be calling the figures for me. We have Oscar Group, okay? Consolidated statement of financial position, right? Statement of financial position as at when, please?
1 December 20x2.
As at 31 December 20x2, right? Okay, so we have the non-current asset. So we have the asset. Then under the asset, you have your non-current asset. So what do we have under the non-current assets? Yeah, start calling for me, please.
PPE.
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 Followed by what?
Investment in Trigger.
that is your goodwill, right?
Okay, yes.
Okay, then followed by what again?
Current assets.
So we have our current asset, right? Then we'll have our total asset, then followed by equity and liabilities, right? So under equity, what do we have? We have the
Share capital.
Share capital, our
and
reserves, then followed by what? Then you bring in your non-controlling interest, Abby. Then we have liabilities, correct? Liabilities. Okay, so this is just how it looks like. Then, once you have done this, the question also required that we should calculate the statement of profit or loss too, right?
Yes, sir.
So you have Oscar Group, consolidated statement of profit or loss for the year ended 31st December. So for this P&L, all you need to do is to leave some space. You don't need to start anything. Then move on to workings. Leave some space for it. Okay, we'll move on to working. So working one, investment analysis. So we were told that hello, we were told that look at the I can close this now, right? Okay, so look at it. We were told that Oscar acquired 25% of Tiger on January 1, 2001 for 2 million, right? So you can call it first acquisition. How many percent? 25%, Abby, right?
Yes, sir.
On 1st of January 2001, correct? Is 2000 and X2000 and X1. I don't know why they're using X1. Okay, then they now said second acquisition took place when? 35%. When?
30th, yes, 30 September 20X2.
30 September 20X2. Right? So this is what we have. So that means our
30.
Okay. So that means our total acquisition is what? 60%, correct? Then the non-controlling interest is what? 40. Do you get it? Sorry, I hope this is clear to everybody.
Yes, sir. It's clear.
Now, we are to prepare for which year? We are reporting for 31st of December S2, Abi. So we are preparing for.
Is raising her hand in the chat box.
Okay, let me stop. Maureen. Yeah, speak. I'm listening.
It was before you started this question. I wanted to ask a question that you just give us like 3 minutes to quickly write the explanation you did before.
So do you still need that time now? Or it is done.
It's not done because you've covered that. You've gone out.
Should I hold on for you? Should I hold on for you to quickly 5 minutes to quickly take note of all those explanations?
Yes, sir.
Oh yeah, do that in 5 minutes. So we'll be back by 8:43. 5 minutes. So write down anything I've said. So I will not speak. I'll just hold on for you guys to take notes.
Sir, please, can you take? We are not seeing that those explanation parts. You've not taken it there.
You mean here?
Yes.
Okay, this survey, right? Are you referring to this?
Yes, sir.
Okay.
So I'm true with this side. I don't know about others. It's as if I'm the only one that want to write. Thank you, sir. So I'm done with this part. Thank you, sir. Sure, So I'm through with this part. Okay.
You should be done, right? Even though I'm going to send out this
Yes, I'm
Word.
true, sir. Just
Yeah, I'll send out
finished.
this Word document to everyone after the class, so you can still go through the entire. I'm not going to delete it. I will send it.
Thank you, sir.
All right. So we've done this first part. So I was trying to analyze that we are preparing the accounts up till 31st of December 2022, 20x2, right? Let's say 2022. So which means that our focus in 2022. Now, note. From January, let's say from, that means 2022. So from 1/1/20s2 to 31st December 20s2. Remember that it is 25% Abi, which is what? Association. However, from 38, from 1, no, it will stop at 38 Abi.
Mr. Kazeem is not it's not
30,
December.
it is 38 9 Abi. Then from 1st October 20s2, like this Abi, to 31st December. Like this Abi, we acquire additional 35%, which now makes it a what? subsidiary. So the implication of this is that whenever you are consolidating these companies now, okay, as at 31st of the, yes, please, I'm with you.
This from 1st of January is 20x1.
No. I'm looking at the current year that we are reporting for. I forgot about the date it was acquired. For the current year that we are reporting for, the current year we are reporting for is 20S2, Abi.
Yes, sir.
So which means that in 20S2, 9 months. 9 months. 9 months is what? 9 months is MTH, Abi. Then the balance 3 months, the balance 3 months is what? Subsidiary. That is what I'm trying to. That is what I'm trying to explain to you. That 9 months is associate. Then the balance 3 months is what? Is subsidiary. That is exactly what I was trying to explain to you. Okay. Now, so for your CPL now, this is very important for CPL. When you are paying your PL, what it means, profit or loss is for the year ended, right? You are preparing for a year. So your PL will be consolidated only for 3 months. Your PL will be consolidated only for 3 months, while your associate will be consolidated while your statement of financial position will be consolidated as at the end of the year. As at the end of the year, you're already a subsidiary, whereas your will be consolidated only for what? For 3 months. I don't know whether this is clear to everybody. Before I move on, I'm taking time to explain. That's why I'm not rushing. That's why I'm not rushing. So the next thing is goodwill. Let's calculate goodwill on acquisition. So since we already know. So first of all, we have purchase consideration of new investments. How much? What is the purchase consideration of the new investment that we just bought now? Let's read now. You said?
6220.
$4,200,000.
4.2 million.
Okay, a further 35% was acquired for 4.2, Abi. 4.2. I've seen it. Why am I flipping up and down like this? 4.2. Now, then, okay, we move it down. Then the initial one, we say fair value of initial investment or acquisition. The initial was 25%. So how do you get so we need the fair value of the 25%. So I want you guys to work it out for me. Now, look at the questions very well. This is the question. They said that if they now said Oscar acquired 25% of Tiga for 2 million. So this 2,020,000 is the cost of that 25%, right? And it has significant influence over financial and operating. So this is the cost. However, they now said that at 30th of September, Tiga share price was, what am I doing now? Tiga share price was 14.5. So can you calculate the fair value of this 25% for me? In some questions, they will give you directly, but these questions prove to be a little bit stubborn. So you are not given directly, so you need to calculate it. So what would be the fair value of the initial acquisitions, please?
$2,900,000.
How did you calculate it?
That's 2.9.
That's
2.9, sir.
How did you calculate it? Proof.
Okay, the ordinary share capital of Tiga is 800,000 at 1 naira per share. So 25%, since 25% was acquired by Oscar, 25% of 800,000 which is giving 200,000.
Mhm.
That's their own share
Okay.
in Oscar share in Tiger. And now
Okay.
we're told that the price per share of the price per share in Tiger is now 14.5 times 200,000 times 14.5 per share is giving 2.9 million.
Okay. Does anybody have thank you so much, Maureen. I sincerely appreciate your analysis. But does anybody have any contrary view to what Maureen has just explained? Or do you
No,
require
sir.
You said what?
No, sir.
You agree with her, Abi?
Yes, sir.
Okay. Any other persons too? All right. So thank you so much, Maureen. You are 100% correct. So let me explain to everybody now, in case anyone is struggling. So Oscar acquire. So 25% of Tiger is what we want to fair value, right? So to know the number of shares, it is simply this 25% multiplied by the number of shares that Tiger have, which is 800. So let's do that one first. So we'll say 25% multiplied by 800. Now, what is the fair value of each share? This 25% of 800 will give you the number of share, which is about 200. Okay. Now, each share fair value, the fair value of each share was given at 14.5. So all you need to do is to multiply it by 14.5. So she said that gives us 29, Abi. Okay, that's 29. So if you sum up this now, this is our total. This is the purchase consideration. So that total is how much? This should be how much, please? 7.1. Am I correct?
Yes, sir.
Yes, sir.
Okay. So are we using fair value method or proportionate of net asset method? Did they tell us whether we should use fair value method or proportionate of share of net asset method?
We're not told.
About what do you mean? Look at this last paragraph. Oscar elected.
I think it's at fair value.
Yeah, let me read it out for you. Oscar elected to measure non-controlling interest at the date of acquisition at fair value. So you have to be careful. Don't just jump. Read very well. So what is the fair value of NCI? You should be able to calculate it, right? Fair value of NCI. Now, note, in this case now, our NCI is 40, Abi. Right?
Yes.
So you are not giving, I don't think they gave us directly. So the same method that we use for this is what we're going to use for NCI also. So that's 40% of 800 multiplied by 14.5. So how much is it? How much? %40 of 800 multiplied by 14.5 is how much?
4,640.
4,640.
4,640. No, 4,640.
640.
Thank you so much. So total it, please.
$11,740.
11,740.
11,740. Now, so assets acquired now. So what is the ordinary share of the subsidiary Tiger? What is the ordinary share?
800.
800.
Now, pre-acquisition reserve. So hold on, please, hold on. So for the pre-acquisition reserve, are you going to use the pre-acquisition? Let me go back to now. Are you going to use the pre-acquisition reserve of the first acquisition, or are you going to use pre of the second acquisition? Which one are you going to use? You know, each of these acquisition they gave us pre-acquisition reserve. So which one are we going to use? Is it the one of the first?
The second
The
one.
The second one.
Why are you using the second one?
because that was when the control was actually achieved.
Oh, you are very, very correct. Thank you. So what is the pre-acquisition reserve for the second one?
7.8.
7.8. So did they give us anything like total fair value of identifiable assets or all those things they used to say? Let's check.
Yes.
Yes.
What did they say?
9.2.
So, okay, let's read the second paragraph. The fair value of Tiger identifiable assets as at that date was 9.2. So if it was 9.2, then what will be responsible for the difference? Did they tell us?
Yes, a brand. The difference
Okay,
between the
look
fair
at
value
it.
of
The
identifiable
difference,
net assets.
okay, and that brand too, we need to depreciate it for how many years? For 5 years, Abby. The difference between the fair
Yes, sir.
value of the different something was 5 years, Abby. The brand was expected to have an average remaining useful life of 5 years from 30th of September. We are coming back to that. But first of all, 9,002, Abby. So there will be a brand. Let me asterisk it. So the total here will be 92. Correct? 92. Now, if the total is 92, how much do you think is going to be brand? So that will be 92 minus 78 minus 800, Abby. How much is brand?
600.
600. Abby? So now, what's the goodwill? Our goodwill is how much now with this? 11,740 minus 92.
2,540.
2,540.
2,540, Abby. So this is the goodwill on acquisition. So, but we have one more assignment to do. So the brand now will pass entries now. Debit your brand, Abby, which they have recognized under PPE or so. Debit your, but that's 600, Abby. Then credit your net asset acquired. That is 600. Then they said that the brands has how many useful lives to go. The brand were
5
estimated
years.
to have now from this September 30, it has 5 years to go. So meaning that for this year, we can only consider how many months now. That's from October to December, Abby.
Yes.
3 months. So so it will be amortization because it's an intangible asset. Amortization of brand. So that's going to be what we have. That's 600 divided by 5 times 3 over 12, Abby. How much, please? 600 divided by 5, then you now multiply it by 3 over 12.
30.
30.
30.
30, Abby. So let's pass
Yes.
entry. Now, this brand is owned by who?
Tiger.
Let me do one thing. All my
Yeah.
accounting entries, let me use red so that when we are posting, we will not forget. Brand is owned by Tiger, Abby. That means subsidiary, Abby. So, and I said any asset that is owned by subsidiaries, surely you have to share the entries between the group and NCI, correct? Because subsidiaries profit belongs to 2 people, right? So first of all, you debit your group P or help, you debit your NCI, then you now credit your brand, which they have taken as part of PP. So this is 30, Abby. Now, that will be, it will be ratio what? 60 and 40, correct? The total is 60, right? The parent is 60, correct? Is 60% is on. So what is 60% of
60-40.
what is 60% of 30?
18.
18. Then the NCI will surely be 12. So finally we are done. We are done. So I don't think there is any other adjustment for us again to look into. So like now we have done all this and there is no adjustment. The difference between fair value of the identifiable assets, we have already taken care of it, brand, and we have differentiated it. So ladies and gentlemen, please listen carefully. Whenever you see any statement like this, that income and expenses are assumed to accrue even during the year, I repeat, whenever you see any of these statements, note that it is likely going to be an acquisition during the year question. So your CPL, you will prorate it by the number of months that you have acquired. So this statement is always a trigger that income and expenses are assumed to have accrued evenly. This statement means that you can prorate your income and expenses over the number of months. Okay, so when you see this statement, that question is talking about acquisition during the year. So your CPL will be prorated by the number of months acquired. So that is always a trigger once you see this kind of a statement. So now we don't have any adjustment to do. All we need to do now is to prepare our reserve NCI and consolidate. However, we need to do one thing. That one thing is that we need to do one thing before we prepare reserve and NCI and consolidate. Then that one thing is that you remember that here the status of the investment changed from associate to subsidiary, right? It changed from associate to subsidiary. So we need to calculate profit or loss on the recognition of associate. Don't worry, it is very, very simple to do. So this would be working what or working 30. Working 30. Profit or loss on the recognition of associate. Okay. Now, the date of recognition is what? What is the date of recognition?
30th September.
That's the 30th September, the date that we've lost control, that we now acquire additional 35%, Abi. So date of recognition is 30th of September. Sorry. Let me change this to red so that all our entries will not forget any. Okay, 30th of what, September. So you will pick the fair value of the investment in associate as at the date of the recognition. So the fair value as at that date, we have calculated it. That is the 29 you got that time, Abi. See, as this is it, the fair value of associate as at that date of recognition was gotten as 29. Do you remember?
Yes.
29. Okay. 29. So it's 29. So you will now less the carrying amount of the carrying amount of the investment. So how do you get the carrying amount of the investment? It's just the simple things, cost. So what was the cost of that 2 million and something that we did? The cost was how much, please?
2,020,000.
2,020,000. Abi? Then
Yes.
you pick share of post acquisition reserve. So the share of post, how should I do it now? Sorry, I'm coming. I'm trying to make it tidy for you. Post acquisition reserve. You remember that it's 25%. So when we acquire this associate, what was the reserve then? When we acquired the 25%, what was the pre-acquisition reserve?
5.8.
5.8.
The pre was
5.8.
5.8. Now, as at the date that you are giving up that investment, then the new reserve is how much? As at the date you are giving up 25%, what is the new reserve?
7.8.
7.8.
Correct. That 7.8 is your current reserve as at the date you are giving it up. Then when you acquired it was 5.8. So that means the post is actually 2,000, right? Then you take 25% of it. That's your post acquisition reserve. How much is that, please? How much?
500.
500, correct. So we have what now? We have 2,520,000, correct?
Yes.
2,520,000. So what is the gain on the it's going to be a gain on the recognition for sure. Reason because the fair value is more than the carrying amount. So what is the gain?
380.
Gain on the recognition. You said it's
380.
380. So this will be recognized in our reserve. Okay, now we are done. So let's do the consolidated reserve. So that is working for. Sorry, guys. Hope you are getting this thing. No, that's why I'm slowing down. I'm not rushing. Just for you to understand what I'm doing. Okay. And the good news is that once I'm done with this class, I will load this thing on YouTube immediately. Then you can go through it as many times as possible because there is a past question that I want to give you as an assignment on this topic. It only came out once, but you already have plenty of things you have with you. So maybe next weekend, well, I will tell you. But for now, finish those one you have first, then you come back to this past question. Okay? Consolidated, but you have time to repeat this class as many times as possible. This lecture, sorry, because the video will be loaded on YouTube for you. So you can always rewatch it as many times as possible. But still, I'm slowing down. I'm not rushing just to ensure that you truly understand this concept. And I'm happy to always recap whenever you are lost. So we need to get the result. So let's move on. The Oscar is a parent, Abby. Oscar, right? Then there will be two tiger. I want to tell you why there will be two tiger. Oscar, there will be tiger when we had 25%, and that 25% now changed towards 60%. Are you with me? Hello, are you with me?
Yes, sir.
Hello?
Yes, sir.
Okay.
Yes, sir.
So what is the reserve as per account? What is the reserve of Oscar as per account?
5.8, the first one.
No, Oscar, the parents.
Okay.
39,920.
39,920.
920.
Okay. Now, Tiger, whatever you have here as per account is your final reserve as at the books, Abi. So
Yeah.
for Tiger, okay, the one of Tiger as per the account in the books is how much? Give me that one first. As per the account, that will be 79. It will be, that's the latest reserve. So 79. Now let's do the leave 25% out. You will still tell me. I'm coming back to that pre-acquisition reserve. So our pre-acquisition reserve. So for when we add 25%, I think it was 5.8. You confirm it, Abi?
Yes.
Yes, sir.
Then when we now
Yes, sir.
purchase the 60%, the reserve was 7,800. Am I correct?
Yes.
Yes.
Now, so which means that the one you are going to have here too will be 7,800. The reason being that when you lost that 25%, okay, the reserve was 7,800. So you can refer to the same thing principle that we use here. As at the date that you lost that 25%, your reserve was 5,800. You can see. So let me use the arrow to draw it. So let me use the arrow to show you something. Let me use the arrow. Where is my draw sign? So what remains is that this will always match with this. Okay? These two reserve will always equal. So that's the implication because the transactions occur the same date. So the two reserve will always match. Okay? because as at the time you lost that 25%, you acquire 35%. That same day the reserve was 7,800. So that is exactly why your final reserve for 25% will have to be 7,800. So this is 2,000. This is 2,000, and this is what 100, right? So what is the share? What is the share of post? Share of post acquisition. So you do 25% of 200. That should be 500, Abby. Am I correct?
Yes, sir. Yes, sir.
Then what about 60% of 100?
60. 60.
60, Abby.
Yes.
Okay, so is there anything that we are supposed to adjust to the profit? Let's start from the note 1. Nothing in note 1 in working 2. No. Here, brand. Abby?
18.
18,
Yes.
Abby. 18. Amortization of brand. 18.
Yes.
Then any other thing again?
That I think that's all.
No, this gain on recognition, you take it there.
380.
380. Gain on the recognition. 380. So can you sum up everything from the beginning to the end, please? 3920, 500, everything. Sum.
4842.
40.
842.
840.
222.
Please, somebody else should confirm or auditor. So
4840.
thank you, ma'am. Last one is non-controlling interest. So this one is straightforward. What is the fair value of NCI? What is the fair value of NCI, please? We have gotten it now when we did our goodwill, Abby. Okay, let me show you.
4640.
4640. So, share of post acquisition. So that will be 40% of 100, Abby.
That's 40.
So it is this one we are taking on. Don't take the 25%, so it is already sunk cost. What you're after is the latest one, which is 100. So it is 40% of 100. So that is 40, Abby. So is there any adjustment that we need to do through NCI?
Yes,
Let's
the brand.
Yeah, Abby.
Yes.
Amortization, Abby, of brand. How much is it? How much is it?
12.
12. So, total.
4668. 4668.
Like this.
Yes.
Okay, so with that is me. Let's balance our account now. All right, so PPE, can you call the figures for me? We have how much for parents? 38,650, Abby.
38,650.
650 plus
76.
plus 7 plus 76, Abby.
Yes. Yes.
Then plus that Okay, let's do this one
Minus.
separately. Brand. No, we'll do brand. Brand is an intangible asset, so I will call it
Okay.
intangible asset. Brand. So don't let us merge it with PPA for good financial reporting.
250.
46,
250.
250, Abby.
Yes.
So for the brand, that's 600 minus 30, Abby.
Yes.
Eh?
570. Yes.
570. Then what did we arrive at as goodwill? Our goodwill was 2540, Abby. It's 25. So can you total this three, please?
$49,360.
49,
360.
360. Okay.
Yes.
Current assets.
12,700.
Is it parent?
Plus 2. Yes.
12,700
2,200.
plus 2,000.
200.
I don't think there is any adjustment. So
No. 14,900.
14,000.
900.
900. All right. So what do we have now? The total is what?
64,260.
Eh?
64,260.
64.
64,260.
260. Okay. Equity and liability. What's our equity? Our share capital.
10,200.
10,000.
200.
Then the reserve is how much? 4842. Total
51,042.
51,042. So what is the NCI? $4,668. All right. So total it, please.
57,710. 55,710.
55,
710.
710. So what's our liability?
7,450.
7,000
450.
plus
1,100. 1,100.
So what do you have?
8,550.
8,000. So is the question, did it balance?
64,260.
Did it balance?
Sir, can you scroll up so I can see?
64?
260.
64 to 60. Balance.
Balance.
It's balanced.
Yes, it's balanced.
All right.
Yes.
So
Yes, sir.
let's work on the CPL. So for the CPL, that one is very clear. We need to do it for 9 months. Okay. The CPL is just for 9
9
months.
or
That's,
3 months? 9.
I'm so sorry. It's 3
September
months.
to December.
Yes, you are perfectly correct. So just keep calling everything for me. Revenue. So
Revenue.
revenue is what now? The parent is how much?
10,200.
Plus, you say 10,200 plus 9. I mean, why am I saying 9 months? 3 over 12 times what?
Times 3 over 12 plus.
Eh?
It's 10,200 times 3 over 12.
No, 10,200 plus 3 over 12 of 4,000. You know, you are only taking 3 months of
okay,
tithing.
okay.
You understand, Abby?
Yes.
Of 4,000. How much, please?
11,200.
11?
11,200.
Like this, Abby. So
Yes.
cost of sales. Cost of sales is the same formula. That's 9,000. 9,000 plus 3 over 12 times what? 3 over 12 times
36.
36.
9,900.
Hmm?
9,900.
Like this,
So
Abby.
that cost, yes, that cost of sales is cost of sales and expenses, so that we get profit before tax.
Everything. It will be too long for me to type. Well, you know, you can type. You can write your own in full. So what's our? What is it? No, don't call it profit before. Don't call it profit before tax. Yes, we have some adjustment to make. 1.3, Abby.
Yes. Yes.
Two things. First of all, you know, it was an associate for 9 months, Abby.
Yes.
So you say share of associate profit. So it will be 9 over 12 times, no, it will be 25% of what is the profit of of Tiger is 320, Abby.
320.
The profit for the year of Tiger is 320, Abby.
Yes.
So you take 25 of 320, you will now divide it by 9 over 12, since it was there for only 9 months. 9 over 12. How much? 25% of 320.
60. The total answer is 60.
60.
Yes.
Then 9 months. After that 9 months, you now derecognize the associate. So you take the profit on the recognition.
Okay.
The recognition. How much is the profit on the recognition? 3. Is 3 what?
So can you scroll like down?
380.
380, Abby.
Yes.
So
1,740.
no, this is your profit. This is your profit before tax. 1,000 what?
740.
740. So what do we have next?
We have income tax expense.
That's income tax. That's it. How much is it? That will be
360 for parents.
360 plus 9 over 12 times 80, Abby. Abby?
Times 3 over 12.
3 over 12, sorry. 3 over 12 times 80. How much?
That's 380.
380. Sorry,
80.
hope you understand why I use 9 over 12 here. Because you are calculating the profit for associate, and the associate was there for 9 months. Okay?
Yes.
So then what is the profit for the year?
1,360. 360.
360. So what else again? Do we have other comprehensive income?
Yes, we have.
Okay, other comprehensive income. There is gain on PPE, Abby. So we have
Yes.
gain on PPE. So that's how much?
Parents 240. Parents 240.
Parent is what?
240.
Parent is 240, Abby.
Yes.
240 plus 9 over, plus 3 over 12 times what?
80. 80.
80, Abby. How much is that?
260.
Now, associate too will take his own share. So you take associate, I will explain now, of gain on PPE. So the associate will be, associate is 25% of 80 multiplied by 9 over 12. Remember that this gain on PPE, let me go back to the question, 80 now, is for the whole year. But the first 9 months was associate, And the balance 3 months was subsidiary. So definitely associate has to take his own share too. So that gives us how much?
90. 15 rather, 15.
15. So we have total is what? 275. Am I correct?
275. Yes. Mr. Kazeem, please, there's
Yes,
a
please.
message for you in the chat box.
Okay. Let me read it. Well done, sir. Will the depreciation of brand, will the depreciation of brand not be included in the cost of sales? It will be included. Well, I'm so sorry. We're forgotten that. We need to go back. We need to go back. So the brand that we depreciated, it has to be included in the cost of sales. You are very correct. It's an omission from us. So now let me now throw this question at you. How much do you think I'm going to adjust for brand in the cost of sales as depreciation? We discussed this last time in the classroom. How much do you think we're going to adjust for brand depreciation in the cost of sales? Hmm? It is the 30, right? Remember that we are just consolidating, but when we are computing NCI, we need to take off this 12. So it is the 30 that will be adjusted. So thank God I'm using computer. I can always delete. So it is you guys that will cancel. You need to do some work on your notebook. So plus 30. It's too long. Let me do this. Let me say hand like this. So this is 9930. Am I correct?
Yes, correct.
So this one called, what do we have here?
1270.
1270, Abby. Then here, what do we have?
710.
1710.
1710. So what do we have here?
1330.
Like this, Abby. So
Yes.
our final answer here is total comprehensive income. What is it?
1605.
1605. So we are done with this. However, two things left. We need to do share profit. So let's do profit for the year. Attributable
So ṣé tí
to
mo ṣe after táwọn tó máa ń drop into lọ my boss was like that pé ṣé màá máa lọ lé kí n lọ ṣe ọkàn yẹn kàn ní play that
you are on mute, you are on mute, madam. Oh. So profit for the year attributable to is anybody in the class safe?
Yes,
Is anyone?
sir.
Oh
Yes, sir. But me, I have a question now.
Okay, you are in the classroom now, right?
So I have a
No,
question.
no.
Okay. Yeah, question.
My question is, why did we have to take the 30 to cost of sales?
The reason is that when you are computing NCI now, you remove that NCI from this NCI that we want to do it now. So now we need to you adjust for the entire figure in the cost of sales. Now that you want to calculate the NCI's money, you will need to now remove NCI's from it. Oh yeah, let's do the NCI now. So the NCI is 40%, Abby. No, let's show it as working separately, Abby. So
okay.
let's show it as working. So total comprehensive income attributable to A, owners of the parent, and B,
non-controlling interest.
Yes. So so first of all we need to do for the NCI. So let's say working skill and machine. That will be 6 NCI P or L. Okay, on profit for the year. Now this NCI is for SOFP, right? Now, so the question is this: what is the NCI on profit? So that's 40% of what is the profit for the year of the subsidiary? 320, Abby? Times 3.
320.
Are you lost?
No.
40% times 320. How much is it?
32.
32.
32.
Then you will now adjust for that amortization of 12, right? It's 12. You
20.
adjust for it. So that means it is 20, Abby.
Yeah.
20 is the final. So you come here. Very on point. It is 20. So NCI and profit for the total profit for the year is 1330, Abby. So if this is 1330, so what will be the ones for the owner of the parent? That should be 1310. So we're done. So we'll do it for these ones too. The second one is 1605, Abby. This is 1605. So let's do the NCI too. That should be working what? Working 7. NCI on total comprehensive income. All right, so you just pick, you continue from working 6, NCI on profit for the year, which is what? Which is 20, Abby. Then let's look at our other comprehensive income. You can see we only have one item, which is 80, Abby. Gain on property valuation 80. So you take the NCI share of this 80. So
40%.
how? So it's going to be gain on PPE. So that was 40% of 80 of 3/12. How much?
8.
8. 8, Abby. So
Yes.
we have 28.
Yes.
28. So you come here. You bring 28. So what is the difference now?
1577.
1577. Okay, I think we're on point. So that's the end of the solution. So let me stop the recording now so that this thing doesn't get longer than this. Then I will now listen to your what's it called, explanation. So let me stop recording now. Where is it? Or more record? Stop. All right.